Let's talk about geopolitical risk and our current market outlook given what's going on in the Middle East. Concerns about rising geopolitical tension are rippling through the market, resulting in investor anxiety. We understand that. It is important to address potential scenarios and show how a long-term approach to investing helps smooth out any bumps along the way. I'm Udayan Mitra, Co-Chief Investment Officer here at Trajan Wealth. I have decades of experience managing portfolios through all kinds of markets. I want to share some of my perspectives on how current events are affecting the markets and how to stay calm and confident during these uncertain times. Recently, I had the privilege to attend a global wealth conference featuring keynote speaker Mohamed El-Erian. Mr. El-Erian is one of the most respected voices in the financial markets today. Drawing on his experience as the Chief Investment Officer at PIMCO, the world's largest bond fund manager, and his leadership of the Harvard University Endowment System, his perspective offers a valuable framework for understanding today's geopolitical uncertainty and what it could mean for investors going forward. 3 potential scenarios. Mr. El-Erian outlined 3 potential paths forward in the current conflict in the Middle East. Scenario 1. A quick resolution to the conflict. If the conflict ends quickly and decisively, markets would likely rebound just as fast. In that case, investors who stay disciplined and have some measure of liquidity may benefit from buying opportunities during the current sell-off. A classic case of buying the dip. Scenario 2. A prolonged conflict. If the war continues and begins impacting oil and gas infrastructure across the Middle East, energy prices could rise significantly and stay elevated for a protracted period of time. That would create a ripple effect. Higher inflation, slower economic growth, and continued pressure on the financial markets. This type of environment is often referred to as stagflation, a situation that we last witnessed during the 1970s. Scenario 3. Global escalation. In a more severe outcome, prolonged conflict could significantly damage energy infrastructure across the region, crippling productive capacity of energy for decades to come. From there, the risks expand. Disruptions to global trade, increased geopolitical fragmentation, rising tension among the major powers. In this scenario, globalization slows dramatically, negating all the benefits from trade. Economic cooperation weakens, and the risk of a deep global recession or worse rises meaningfully. So where are we now? At this point, a quick resolution appears unlikely. Energy markets are already reacting with oil prices rising and key supply routes under pressure. Economic data is also beginning to reflect that strain. Job growth is slowing, inflation is trending higher. Markets are showing signs of fatigue. Taken together, these indicators suggest we may be entering the early stages of a scenario 2. That said, the possibility of further escalation cannot be ruled out. So what's the Trajan Wealth strategy? In environments like these, our focus is not on reacting emotionally, but on positioning our portfolios for long-term resilience. At Trajan Wealth, we're emphasizing 3 key principles. 1. Invest in high-quality companies. We prioritize businesses with strong balance sheets, consistent cash flow, and manageable debt levels. Even in downturns, these companies are better positioned to endure volatility and better positioned for growth once the waters are calm again. 2. Resilient sectors. We continue building exposure to essential industries. Sectors such as infrastructure and commercial real estate generally remain more stable over time. 3. Income and downside protection. For qualified clients, we may also utilize investment vehicles like senior debt strategies. These sit higher in the corporate or real estate capital structure and have less correlation to the capital markets. This means they generate consistent income. They have built-in protections that can help insulate from volatility because equity and lower-tier debt serve as shock absorbers and deflect initial losses. Staying focused. While headlines may feel uncertain, our approach remains consistent. We focus on disciplined investing, risk management, and long-term planning. This way, our clients can stay confident, even in unpredictable environments. In uncertain times, a consistent, unemotional approach, guided by an experienced fiduciary advisor, can help steady your portfolio. You don't have to manage your assets alone. If you have questions about how your portfolio is positioned, we are always here to help. For more content like this, please like and subscribe. Thank you very much.